Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from hundreds of successful individuals from around the world. I am your host, Ashutosh Garg, and today I'm delighted to welcome a very accomplished investor, Brian Adams from the U.S. Brian, welcome to the show.
Thank you so much for having me.
Thank you. Brian is the president and founder of Excelsior Capital. He spearheads capital markets and investor relations. He's a former practicing attorney, and he's served on several boards. So, Brian, let's start talking about Excelsior Capital. Tell me about this venture.
Yeah, absolutely. So it's an iteration of a company that I started 11 years ago, and it is a syndication platform based in Nashville, Tennessee. And when I mean syndication, we raise capital on a deal-by-deal basis to a network of individuals and families investing into commercial real estate, which for us can mean anything from office to industrial to flex, medical, retail, et cetera. But fundamentally, we're trying to solve three problems that we see our investor base having. One is access to good quality direct co-investments. Two is solving for some kind of yield component. People are looking for passive income. So we try to achieve a double-digit cash on cash yield annualized that we distribute monthly. And then we only work with taxable investors. We don't have institutional folks. So we do everything we can to accelerate all of the tax benefits that come from direct real estate ownership, namely through cost segregation analysis and accelerated depreciation.
Wow. So you mean you are also handling individual investors, is it?
Correct. Yeah. The majority of our investor base are individuals.
Wow. Okay. So my next question, Ryan, and I've often asked this from many people, that when you talk of wealth managers or people who manage wealth, most of our wealth is a combination of money, from an Asian perspective, jewelry, property, and art. Why is it that the focus is only on cash?
So there's an old adage amongst European families that have existed for thousands of years that you should divide your wealth into gold, art, and property. Correct. Right? That sustains multi-generational wealth. I think because America is such a young country still relative to other parts of the world, obviously India and other places in Europe and Southeast Asia, it's very hard for us, I think, sometimes to see along a multi-generational time horizon, maintaining a quality of life across that type of spectrum. And so oftentimes we get really focused on near-term goals, near-term cash generation, watching the stock market every day, those type of things. I think it is a bit of a trap that American investors get into.
Okay, because you're right about what you just said about European investors. Historically, old grandmothers' tales are that in India and China, you invest in gold and land.
Right. My business partner is Gujarati. And so, obviously we have a lot of investors who have sustained generational wealth through gold, jewelry, land holdings, et cetera. So, I completely agree and understand. And I personally have a huge allocation towards real assets, obviously. And I think it's interesting to see what's happening with this fractionalization of ownership of real assets where, through various forms, you can now get partial ownership of art, of, if you believe crypto is kind of the modern gold. Correct. So there are more and more people looking to allocate that way, but I think it's very hard to change the mindset overnight for American investors.
Wonderful. And do you have any particular investment philosophy or any sectors that you focus on?
Yeah. So at Excelsior, we only do real estate. So for us, we're only focused on commercial real estate. And so our investment philosophy is, U.S. commercial real estate is the best place to be relative to anywhere else geographically in the world, but then also in the U.S. itself, right? So if you're looking for appreciation, if you're looking to hedge inflation, if you're looking for good, stable cash flow and all these tax advantages, we believe U.S. real estate is the best place to be right now.
Okay. And it's also often said, and I've been an amateur investor in the equity markets, but they always say that in the long term, equity is always the best investment. I've asked this question from many people. What is long term? I'd love to get your perspective.
Yeah. So, and we talk about this with our investors a lot, right? You need to think about allocating capital on a risk adjusted basis, but also on a time adjusted basis. So if you're a family office with 100-year time horizon, it probably makes a lot of sense to participate in raw land holdings outside of growing metropolitan areas. It probably makes a lot of sense to be really aggressive in the equities market. But if you're a taxable investor and looking at things on a 7 to 10 year time horizon, you're right. The U.S. Stock market has consistently outperformed over the last 150 years.
Correct.
But there have been times of massive volatility. And I don't just mean pricing increasing and decreases. I mean periods of time where there was actual loss of capital, permanent loss of capital, which is obviously something that you want to avoid. And so when I think long term, I think for a taxable individual, that's 7 to 10 years. For a family office, generationally, you're thinking 25, 50 years.
Interesting.
And obviously there's implications on a tax basis now. If they do change the carried interest rules, that's going to obviously hugely alter what is long-term and short-term, et cetera.
Well said. Well said. So before you decide to invest somewhere, what are some of the key metrics that you look at?
On a real estate opportunity? So we have an investment thesis overlaid on top of those three principles that I talked about, access, yield, and tax benefits. We have an investment strategy overlay that says that this maturing millennial generation, which is now the largest generational working cohort in America, is roughly 73 million people, are going to continue to migrate to secondary and tertiary markets in the Southeast and the interior Midwest, because they are now entering into a phase of family formation where they're going to choose where to live, work, and play based on cost of living, quality of life, access to single family homes, and access to education for their children, which leads to places like Tennessee, Texas, Florida, the Carolinas, et cetera, all these places that we've heard about recently. So we think that migration will continue to accelerate, and demographics are destiny in real estate. And so we think those markets are going to be really good to be. And on top of that, we go a little bit deeper. We look at specific submarkets. So once we find a city that we think is experiencing year-over-year job growth, population growth, wage growth, we like the underlying economic indicators. We then go on the submarket level. So neighborhoods that performed really well during the Great Recession, neighborhoods that have proven resilient during COVID. We identify typically 2 to 3 submarkets we like in every major metro. And then for us, we're solving for yield. And so we're very cap rate driven. And so we're looking for a 7 to 8 cap rate stabilized cash flow asset. That's obviously very challenging right now in today's environment. There's a lot of capital looking for those type of deals. So we've started going down in our deal size. Okay. So we're looking at $10 million acquisitions, sometimes lower, which there's an adage in real estate that it's the same amount of brain damage to do a $100 million deal as a $10 million deal. But the pricing difference is real. And so there's a premium to be a buyer in those smaller opportunities.
Fascinating. And how is the US real estate market impacted with what's going on globally in the real estate segment?
What's going on in the real estate market in general?
Outside the US.
Oh, outside the US. International real estate markets?
No. So my question was, how is the US real estate market impacted?
Oh, gosh. So this is a great question. And I think very hard for investors, especially based in the US, to understand these dynamics. One of the things that you see playing out are these large institutional investors based in Western Europe or South America or Southeast Asia, who are in markets that maybe are experiencing dramatic inflation. In the case of Western Europe, are experiencing negative yields on their bond portfolios. And so for them, if you're a German pension plan, and by law you have to have a certain allocation towards the German Bund, their bond market, and it's giving you a negative 100 basis point return, relative to that 100 negative basis point return, buying an apartment property in Dallas at a 3 cap, right, unlevered, is going to give you 3%, is crazy for most domestic investors and individuals in the US. But for them, it's a really good investment, right? It's going to outperform their domestic German bond portfolio by a large bit. So you have these really big dynamics occurring internationally that impact US real estate. And also, I think people fail to realize that because it's been a bit of a drawback recently, but because there has been this huge run up in equity markets overall, many of these institutional investors are now under allocated towards private equity and real assets. And so they are going to reallocate in Q3, Q4, and they're going to continue to deploy capital to real assets in the US, which will only drive down cap rates more and more. As long as debt stays this cheap, I see cap rates going down across the board, across all asset classes.
Fascinating. But continuing on the same subject, in the 80s, the Japanese had huge cash surpluses and they came and purchased large numbers of buildings in Manhattan. In the late 90s, the Chinese were doing the same thing. How does an investor in the US factor in these massive capital inflows into the US real estate market and then outflows?
Yeah, I would not want to compete with those type of investors. I think, famously the Japanese bought 30 Rockefeller Square and caused this huge uproar in the US. And we've all heard the stories about Russian and Chinese investors buying empty condos, in major metros like New York, et cetera. I mean, the reason that we go to El Paso, Texas, or Savannah, Georgia, or Fort Lauderdale, Florida, and we're buying 10 million, 8 million, $7 million properties is because we don't have the capacity to compete with those type of investors. And for a long time, when I got into the business, I didn't really understand what cost of capital meant. I had a vague notion of it, but now I've got a really very real sense of what it means. And for these investors, they're not looking for a real return. They're not even really looking for depreciation. They're looking for a way to move capital outside of their domestic countries and avoid tax regulations and other type of extra legal affairs. And so for them, economics don't really matter. And you just don't want to compete in that game. That's not a game that you want to play in as an individual or a family investor, in my opinion. So you need to go elsewhere.
Wonderful. My next question to you is that, as you've been building Excelsior Capital, share with us some of the challenges that you have faced.
I don't know if we have enough time to go through all the mistakes that I've made. There've been a lot. I've been doing this 11 years.
Yeah.
I'm 39 now, so 28 when I started. Some of the big ticket mistakes that I've made or lessons learned, one would be understanding that even though we are a real estate investment firm, we are a small business, right? And small businesses in America fail typically. It's generally an 84% fail rate within 12 months. Those are the statistics for small businesses in America. And for a long time, I didn't fully appreciate the fact that I needed to put time and resources to work in things outside of the investments themselves, right? So marketing, reporting, investor relations, HR, tax, accounting, bookkeeping, et cetera. All these things that underpin the deals themselves, but don't necessarily have to do with the acquisitions or the asset management. And so that was a huge mistake I made, was not putting enough effort or resources to work in that infrastructure. And we've righted the ship from that perspective, but that was certainly a big one that almost blew the company up. This was 7 years ago, probably.
Wow. So, Brian, you're a trained lawyer, and I have two questions regarding that. Number one is, what made you select investment as a career when you're a trained lawyer? And a follow-up question, How does your training as a lawyer help you to make better investment decisions?
So I'll answer your second question first. I think as an attorney, you're trained to be a terrible pessimist.
Mm-hmm.
And so when we go into an investment or we make a major decision within the company,
Mm-hmm.
my mind immediately pivots towards death, disability, and divorce.
Okay.
Right? What happens if the deal dies? What happens if this person I'm doing business with dies? What happens if there's a business divorce? What happens if something goes fundamentally wrong? I look at it through that lens, which I think is healthy. You need to counterbalance that with some really optimistic people, because that's not a way to live life. But I think under certain circumstances, it's a really healthy perspective to have internally. And so that's been really helpful. In terms of why I made the decision I did, I had the opportunity to attend a class taught by an adjunct professor at Owen, which is the business school at Vanderbilt. And this was a serial entrepreneur, multiple exits, very successful person.
Mm-hmm.
And he, before the class started, he said, if you look at the Forbes 400 and you take away everyone who inherited the money or married the money, everybody on that list either had an idea in their garage that ended up going bananas. So think Apple or Microsoft or something like that, Google.
Mm-hmm.
They worked at a large corporation and got stock incentives and stock shares and built up equity over time.
Mm-hmm.
Or they participated in some type of real asset, be it timber, commodities, oil and gas, real estate, etc. Bottom line is nobody got there on a salary.
Okay.
And so I didn't want to play a salary game.
Mm-hmm.
I wanted access to equity because I saw that as a means to create wealth and to maintain a quality of life for myself and my family. And so that's fundamentally why I made the decision.
Wonderful. So I've got one more question for you relating to money, and then I've got 2 or 3 questions for you personally. You are a millennial or a senior millennial yourself. How are millennials and Gen Zs changing the investment landscape?
So there's 13.5 accredited investor household in America today.
Mm-hmm.
Roughly less than 3% have exposure to private equity or alternatives or direct deals.
Mm-hmm.
So I think because of the Great Recession, there's a general mistrust towards Wall Street, right? We keep being told that these are the smartest guys in the world, but they seem to blow themselves up every 10 years,
mm-hmm.
ballpark. And now with the advent of social media and technology, there's no longer this moat around these private offerings or private equity or alternatives. It's now been disintermediated, right? This concept of democratization gets thrown around a lot, but to me, it's just access, right? And so now you can learn about single family rental homes. You can learn about crypto. You can learn about commodities for free, right? Because all the information is out there. You can access podcasts, webinars, LinkedIn, etc. And people realize that, gosh, the folks that have created real wealth have done so through the stock market, but also through private equity. And so I think there's just been a real pivot towards educating and wanting and demanding access to some of these investment offerings that before, they just weren't feasible unless you had, a huge amount of money if you were a qualified purchaser, or if you just happen to have a buddy that could get you into XYZ fund. Mm-hmm. And so I think that's fundamentally where this whole business is going. And you see it played out to some extent with Robinhood and some of these other large crowdfunding sites and just the amount of capital they've been able to deploy.
Fascinating. So, Brian, I've got time for 2 or 3 more questions, and all our viewers and listeners love to get to know my guest a little better. So my first question to you is that what would you say are 3 key milestones in your life or your career?
Certainly meeting my wife and marrying my wife, not only, just emotionally, but her family has a single family office based in Nashville. And so that really opened my eyes to this world of private equity and to alternatives. I didn't really know what any of that was before I joined the family. And then the decision to start the company, my son was under 1 year old. It was, looking back on it, it was exceedingly risky. I don't know if I could have the ability to do that today. But I didn't know enough to be scared, I think, when I started the company. And then the third one would be, this challenging, messy middle period that I went into as a business owner, where I had to really restructure the business, build it from the ground up, on the second iteration that I've been doing for the last 5 years. I think those are the three big milestones for my life.
Fascinating. Time for two more questions. As a person who manages money and has to, therefore be trusted by a lot of people, what are some of the core values you believe in?
Yeah, so I think for me, the values would reflect what I've learned from my own father and my father-in-law, right? Which is hard work and brutal transparency when it comes to any communication you have in your life. I think, especially on the asset management side or being a sponsored GP, a big mistake I see people make is just lack of transparency in general. I think we all understand that we all hope these deals go well. They're not always going to go well, but to the extent that you can, and with technology, it's much easier now, just provide brutal transparency and really clear communication about what's happening very consistently on an ongoing basis, that will solve most of your problems, in my experience. So wonderful. Those would be the two things.
Wonderful. And my last question to you, who or what inspires you?
Honestly, my business partner, his, he has this internalized immigrant work ethic. We've accomplished a lot of things, and we run $450 million worth of real estate, and we're both under 40. Wow. He may have just turned 40, but for him, his drive to grow the company and prove himself to his father and his father-in-law, and continue to innovate and to continue to improve our systems and processes and build a first-class company platform, it keeps me pretty motivated, frankly.
Wonderful. Brian, thank you so much. It's been such a pleasure speaking to you. Thank you for educating me and all our viewers and listeners on so much on real estate financing and money. Thank you again, and good luck.
Thank you so much for having me.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website, www.tbcy.in, to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.